Lately, I have been noticing a trend that has been popping up on certain YouTube channels that I frequently visit because a lot of their content is actually very well thought out analysis. And the latest iteration is the risk of a potential market crisis caused by the Fed's reverse repo operations that they have been doing for the last 3 months. And to them, it could cause a crash in the repo markets, much like what they did in 2019 when the overnight financing rates increased from about 2 to 2.2% all the way up to over 5%, and in some cases it actually popped in the overnight rates up to almost 10% in one day. And these spikes in interest rates was caused by a sudden drop in liquidity. Now, to them, what the Fed has been doing has been selling these repo securities on the market. So they're trading and trading out money from the banks with these repurchase agreements. They had bought these repurchase agreements in other operations earlier, and now they are selling them, and they are selling them exponentially more than what they purchased them as. As a matter of fact, the selling has reached almost $1 trillion a day now. It's dropped a little bit in the last couple of days, and so now these YouTubers are saying that this is warning of an impending crash in the markets. I respectfully disagree with these people. I don't think that this is a sign that there's a repo crisis, much like what happened in the fall of 2019. So to properly understand this, I'm going to go over what exactly occurred in 2019 and then tell you why this time it's different, so to say. So back in 2019, we saw a situation develop where repo interest rates spiked in the late third quarter of 2019. And what was happening here was that banks would typically use these repurchase agreements to raise short-term capital. So they would want to finance their daily activities or weekly activities, and sometimes they need a little bit of extra cash. So in the case of a repo, which stands for a repurchase agreement, a bank would sell government securities to usually another bank or to an investor. And it's usually on an overnight basis. So this is a one-day agreement, typically speaking, but it can go longer in the short term. And then buys them back the following day with a slightly higher price, which is dictated by the interest rate. Now this interest rate, this 5.25% here, is usually, if I'm not mistaken, it is an annualized rate. It's not a daily rate. So the banks are not paying back 5.25% on their collateral. This should be an annualized rate. So if this is the annualized rate, they're paying back a fraction of this in order to raise capital. Now, of course, you're dealing with hundreds of millions of dollars, if not billions of dollars, of these repurchase agreements going on every single day. It could be even in the trillions. And so, the cost can add up very quickly. And so that's why this was so much of a concern when the overnight financing rate exploded to 5.25%. There was another problem that started to develop in this, and this was a huge problem that was going on, was that the repo market rates are supposed to follow the Fed funds rate. And you can see that here until late 2019. The fact that the secured overnight financing rate shot up meant that the Fed was losing their control over short-term interest rates. If these interest rates would have been allowed to spike because of an excess of collateral, aka treasuries and mortgage-backed securities that these banks would temporarily sell on the markets to borrow money, this would end up forcing up the federal funds rate, which would force up the bank prime loan rate. It would force up short-term bonds. The cost of borrowing would go up, and we would go into a credit crisis very similar to what we saw in 2008, except it wouldn't be caused by rising debt defaults. It would actually be caused by a shortage of liquidity that would then lead to rising debt defaults because of rising interest rates. However, in this case, the situation is totally different. The reason why is for two reasons. One is that back in 2017 and 2018, when Jerome Powell first became Fed chairman, he started initiating a policy of normalization. So the first thing that he did was that he started raising interest rates. Okay, he had continued what Janet Yellen was doing and was even escalating it. So the Fed funds rate was steadily increasing. Now, in order to increase that federal funds rate, the Federal Reserve has to sell short-term securities on the market to suck out money, because it's the supply of printed dollars in the system that determine the loanable funds interest rates, besides the fact that there's a demand for those loans. So when supply is in excess of demand, the interest rates drop. The Fed was trying to reduce that supply while demand was staying fixed, so that way the interest rates would be forced up. The reason why the Fed was doing this was because it was lulled into a mistaken belief that the economy was actually healthy and was recovered. So when Jerome Powell started doing this, it started putting pressure on the liquidity markets, because he was effectively reducing liquidity. In addition, Jerome was also reducing the number of assets that was on the Fed's balance sheet. So back in November of 2017, the total assets of the Federal Reserve was about 4.5 trillion. And by the time we reached to mid-September 2019, that had dropped to 3.8 trillion. So the Fed had sold effectively $700 billion net of all of their activities of longer-term government bonds back onto the market, and they sold off $700 billion. So they sucked out $700 billion of cash out of the banking system. And this was represented by a drop in reserves at the banks themselves. So banks, ever since 2008, have been stashing away trillions of dollars of reserves because of the credit crisis that occurred in 2008, as well as certain capital requirements that were levied onto them by the Dodd-Frank bill, as well as the Federal Reserve, which is the chief regulator of the banks. In addition, for reserves, the Federal Reserve started paying interest on excess reserves. So banks are required to hold a certain amount of reserves. Usually the number was 10% of whatever their total assets are, and anything extra that was stashed away at the Fed became excess reserves. Before, it used to be that banks were not paid any interest on those excess reserves, so it was not in their best interest to hold on to those at the Fed. They were effectively losing money from inflation. Banks would turn those into loans. Instead, now they're getting paid, although a very low interest rate, for those reserves, but it's a safe haven. It's a guaranteed return. So banks have been stashing away those reserves. And yet since 2014, the reserves have dropped by 1.3 trillion. Since November of 2017, reserves dropped by about 700 billion. So that's where the Fed selling assets became to be seen, was that it started to translate in a drop in reserves at the banks. So banks were holding those reserves at the Fed, and essentially a trade was going on. The Fed was selling assets at the banks would then draw down on their reserves, and then they would purchase those assets. So in turn, in terms of actual real liquidity, it didn't really put that much of a constraint on the banks. Instead, what happened was a combination of corporate taxes having to be paid from the banks, which drew down from their accounts, from their checking accounts. That drew down their excess liquidity, coupled with a record deficit that the Treasury Department decided to unload on the banks, which they do from time to time. And in this case, the two just happened to coincide together, which caused the drop in liquidity and the spiking of the interest rates. But what's going on now, quite to the contrary, is that total assets at the Fed are not dropping, they are steadily increasing. And notice when the Fed started to increase their overnight repurchase agreements, these reverse repos, so to say. So they're selling these securities back to the banks. Well, they started this back in March of 2021, so this is a fairly recent trend, and they have been escalating it ever since. Well, look at what the assets are doing at the Fed. The assets are still going up. So the Fed is selling these securities, but they're still purchasing assets from the banks. And in terms of net purchasing, they are increasing liquidity at the banks, which is resulting in a higher amount of M2, which is what's causing price increases. So there's not a problem of too little liquidity. There's a problem of too much liquidity, so to say, too much money in the system, which is pushing prices up. And yet the Fed is doing this not because they're worried about price inflation. They're doing this because the interest rates for overnight securities has plummeted, and they were worried that it was going to reach negative interest rates, which they are concerned that it would have certain implications in the economy, negative ones. So look at what's going on. In mid-June, the secured financing rate shot up to 5%. But remember what I said before, as long as that secured financing rate is in tandem with the Fed funds rate, meaning it does not escalate above that Fed funds rate for an extended period of time, then there's not much to truly worry about in terms of liquidity. Yet what's going on now? Well, the Fed funds rate is about 0.0 to 0.25%, right? And the secured financing overnight rate is actually 0.05%. So that tells you that the repo markets are flushed with cash, and this is evidenced by the total reserves held at the banks. So the banks had $1.5 trillion of total reserves in October of 2019. They now have $3.9 trillion. This is not the case where back in 2019 reserves were dropping at the banks, even though that really wasn't what the cause of the problem was. This is a case where banks are flooded with reserves. Now, one thing that they do point out is that the Biden administration is running record amounts of debt, and they are running record amounts of deficits as well. So when the Trump administration was running deficits back in 2019, deficits reached over $1 trillion and $1.5 trillion. Well, the Biden administration, according to the CBO, is projected to run over $3 trillion of a deficit this year, which means net-wise they're going to unload $3 trillion into the banking system that the banks are going to have the cash liquidity to purchase. And that's where the concern comes that there might be a credit crunch, because on one hand you have the Fed unloading and selling these reverse repos, and on the other hand you have the government unloading treasuries, and the banks are having to buy both. Yet in this case, with the overnight repurchase agreements, these are usually just overnight daily securities. So the Fed is basically selling treasuries to the banks, and the banks are paying them cash, and then the very next day the banks are getting their cash back. That's why assets at the Fed are not selling. They're increasing, and that's why reserves at the banks are not depleting. They are increasing, because look at what happened to reserves back in September 2019 leading up to COVID. They increased from 1.5 trillion to 1.7 trillion. So net wise, the Fed started lowering interest rates, and they started buying these repurchase agreements, and they increased reserves at the banks by $1.7 trillion. And the Fed also added over $500 billion to their balance sheet, or about $400 billion to their balance sheet, before the pandemic hit and the government shut down. So we're not in that kind of crisis mode that we were back in 2019. Where the YouTubers could be right on is the fact that the Biden administration unloading $3 trillion of debt at the banking system could overwhelm the banks and cause a credit crisis, yet the Fed is purchasing Treasury market securities every single month. And the tune at the rate that the Fed is buying these securities is almost $1 trillion. So the government is not going to unload $3 trillion at the banks. They're going to unload $2 trillion at the banks. And that, although that might be a concern because it's so enormous, banks have so much in reserves that until we start seeing these reserves be depleted, I'm not really concerned that there's a shortage of liquidity. If these reserves did start to be depleted, if they started to drop and started to drop very sharply, sort of like what was going on in May to July of 2020, yet that was caused for different reasons. That was caused because the banks increased their reserves by $1.5 trillion, and then the government started relaxing their shutdown measures, so the banks started to create loans. Then yes, that could be a potential concern. But right now, I think the YouTubers are jumping ahead of the gun here, and that this issue is not the major concern that we should be worried about in the economy right now. We should be worried about too much money putting pressure on prices and causing them to go up systemically, which will have its own problems. And yes, if that does force up interest rates and cause the Federal Reserve to lose control over interest rates, that can cause a credit crisis, most certainly, which is ironic because then the Fed will say that the banks need more cash, which is what causes inflation, which causes the problem to spiral out of control. But the issue is not in what the Fed is selling. The issue is what is the Fed buying, okay? So taking a look at a month-over-month change in assets that's going on at the Fed, they're buying $120 billion of Treasury securities every single month. And look at the change in the assets. Ever since they started the repo crisis, it has dropped the amount of assets net that they are purchasing off the market. But that's all that it has done. And so look, even in June. In June, they purchased $160 billion of government bonds and mortgage-backed securities off the market. So banks are getting flushed with all this cash net-wise, and that's increasing their reserves. So we're not seeing a problem where the banks are drawing down on their reserves yet. Could this become a problem in the future if the Fed were forced to raise interest rates to contain price inflation? Absolutely. Is it a problem now? No, it is not. When will it become a problem? Well, potentially if the net $2 trillion that the government unloads on the banks, coupled with corporate bond payments drawing down on accounts, causes that crunch, then possibly later on this year, perhaps in the fall or winter. But really, honestly speaking, I don't see that being a problem until the Fed has to be raising interest rates on the short-term end. So that's my take on it. I'm not here to disagree with these people. These are good people that are providing some insightful economic analysis, but in this case, I do think they're wrong, and I'm going against their grain on this one. So thank you for watching this vid, and if you like it, like and subscribe to my channel, like the vid, and I'll purchase more of this content and my take on what's going on in the economy today.